Welcome to the Rich Report. Big week this week. Tariffs remain top of mind for Canadians. There's a lot of kind of erratic communication with Trump and at Davos, meeting at Davos over the past week. Inflation has come in low again at 1.8%. That was released last week. And the Bank of Canada is meeting next week. They're looking at lowering rates again. We're going to talk about all these things. We're going to look at why it is just so unlikely that that tariffs are going to come to Canada in any big way. Um, we might see, in fact, a tariff be enacted. I think Trump's next move could hypothetically be saying that, all right, the tariffs here, it's being pushed out, and whether there's another date that it's being pushed out, or it happens instantly. I wouldn't be surprised if there's another further step, and of course all this fear mongering, pressure that really, the global community, especially our closest neighbor, Canada is not used to dealing in this way. And so it's different. It's not collaborative like we're used to, but really it's something that can't, I don't think can come to pass. And I called out on Twitter last week before Trump's February 1st tariff date. I said, he's probably going to make another date. And sure enough, 2 or 3 hours it came out and there's a date. So it's just, it's just kicking the can down the road a little bit more and a little bit more, keeping that fear there. And probably there's some form of deal that he wants to meet. And so the reasons why this can't happen have been circulating. I just wanted to kind of reiterate or confirm on my end some of these thoughts about why it's just so unlikely and borderline impossible for this to happen over the next year or two even. And so the first thing is inflation. So Trump himself said at the Davos at the World Economic Forum meeting over the past week that inflation is his top priority and making sure inflation stays low. And in order to do that, you need lower oil prices. That's definitely one thing. Low oil prices can keep inflation very low. It affects many goods and services over across the world. And cutting off oil from Canada, I mean, he can't do that and have low oil prices. And he says, well, drill, baby, drill. For U.S. companies, big oil producers to drill in the U.S. And they're standing there and they're literally coming out and saying, we're not prepared to do this at $60 a barrel of oil. It's not worth it for us. Somebody else in another country might be able to do it for $50 or $60 a barrel, but not here in the U.S. or even Canada. And so to cut off a major supply of oil coming from Canada just doesn't make sense. Even if they did start drilling in the U.S., it takes years for this production to come online. And by then, with a tariff, preventing Canadian oil from coming down, there would be so much damage done before the oil came online in the States. That's even if the U.S. producers start drilling like he wants. So that's a big thing, very inflationary. It's not feasible to get oil online, drilling online as quickly as he's trying to portray. Another big thing is manufacturing. I mean, there are some cars and other goods that will go across the border several times before it's complete. And so, I mean, for each pass before a car is complete across the border, is there a 25% tariff? You're a 10% tariff. In any case, that would like double the cost of a car. And it just doesn't make sense. It would immobilize billions, tens and maybe hundreds of billions of dollars of factory assets and to build factories just in the States to produce this stuff, this again takes years. It would take until the end of Trump's term before these factories came online. And so again, the damage done over that period, it just doesn't make sense, to just flip the switch and have all the production in the States. There would be a tremendous amount of damage there. Um, Another thing is that, the policies that Trump enacted and the U.S. enacted, the tariff policies that were enacted previously in the previous administration, they weren't really effective. And this is from a really good report that I read from RBC on the effects of inflation, how it trickles through through society, and the tariffs that were enacted previously, they on China. China's the best example. They had bigger tariffs. Well, what happened was the trade deficit in the U.S. balanced out, and they had a bit of a balance with China. But what happened was the trade deficit increased in countries surrounding China and other countries like Mexico. And so, even though they might have been the tariffs might have been effective at starting to balance out with one country, the system and manufacturers find ways to kind of get around that, so that the trade deficit with the States wasn't really impacted that much as a result of those tariffs. The other thing is that economists say that a lot of the U.S. trade deficit is a result of borrowing from other countries to fund their budget deficit. And Canada too. I mean, this causes a big trade deficit, just borrowing from other countries to fund those budget deficits. And so you can't get rid of that without cutting your deficit, your budget deficit, and that's unlikely in the short term. So there's just reason after reason. There are others. Canada sells oil for cheaper. We don't diversify. We haven't diversified our production and who we sell to. And to other countries. And so it's very US focused. There's an oversupply of Canadian oil and a very efficient way to get it through pipes, hundreds of billions of dollars worth of piping right into the States. So that's how they get it for cheaper. It's kind of a sweetheart deal for the States. So there's, again, reason after reason why it just doesn't make sense. But it's not bluster. It's not bluster that Trump is saying, because if it was bluster, if it was dust, it wouldn't be having this effect over the politicians, over the media, of course, and really you see more of a calm in the financial markets. For the amount of damage these tariffs could do on so many levels, you might expect the financial markets to be going a little more volatile, a little more erratic, but they're not, because the rational thought is that there is going to be a resolution here. And so always good to prepare for the worst, but I'm cautiously optimistic. And so the going into next week, there's the Bank of Canada's meeting on January 29th. That's on Wednesday, January 29th. And there's some economists, there's Derek Holt from the Bank of Nova Scotia, who's saying, maybe the Bank of Canada shouldn't cut. Maybe they shouldn't do that 0.25 0.25% cut that the market's expecting and hold off until we have more clarity on Trump's tariffs, on the U.S. tariffs. So that's being put out there, but the majority of economists are saying that no, we should have a 0.25% cut. Inflation is at its lowest point for over a year. It's at 1.8%. It's holding around its low, and it's been within the Bank of Canada. Inflation has been within the Bank of Canada target range for exactly 1 year now. The target range is between 1% and 3%, and so we've been in that target range for exactly 1 year as of this month. And so that's pretty good stability of inflation, and it allows the Bank of Canada to focus more on growing the economy by lowering interest rates. And this is in the face of the economy is not just neutral, even though the interest rate is kind of in the neutral rate range. Which is between, I believe, 2.25 and 3.25%. The current rate is 3.25, so just in the neutral rate range. The economy itself is nothing but neutral. The unemployment is approximately 6.8%, and the population is the growth isn't happening. It's leveling off, if not declining. And so there were these growth factors that were, artificially or not, they were growing the economy, and those growth factors just aren't there. So I think this gives you look at everything together, and absolutely there's a setup for lower rates. By the markets are calling for 0.5% right now, but it could very well be 0.75% or 1% lower rates. I say that because if we look back pre-COVID, interest rates were holding at 1.75%. The Bank of Canada overnight rate, 1.75%. Mortgage rates were in the low to mid 3% range for 5-year fixed mortgage rate, and the economy was doing better then. You didn't have unemployment really creeping up. You didn't have the kind of threats that you do today in the economy. And so, I mean, we really, I think, could handle lower rates. Of course, it's not that straightforward. There are many factors involved. The Canadian dollar is already hitting, the 60-cent range, long-term lows as a result of lower rates and, political instability and other factors. But I mean, we can't just lower as much as we want. There's the U.S. factor there. There's what's the rest of the world doing, but really as a country, Canada, I think could withstand lower rates. So another 0.5% at least. There's an 81% chance there's going to be a 0.25% cut on Wednesday, the 29th, and it will likely proceed. And I'm optimistic that rates should be reduced and in the face of these weaknesses, and even with tariffs, the counter tariffs could be inflationary, but the Bank of Canada, they're not really counting that as real inflation. So when a tariff goes up, it's a one-time increase in price, and then it tends to level off, and alternative goods are found. Other countries or substitute goods are found to kind of reduce that burden of the tariff. So the central banks, particularly the Central Bank of Canada, isn't really considering these countermeasures, these counter tariffs, as pure inflationary activities. And so we'll wait and see there. But it's leaning towards a weaker economy and lower interest rates needed. And again, hopefully, I mean, we have a resolution for these tariffs, and we can have a deal with the U.S. and kind of get this behind us sooner than later. I don't think that'll happen in the next week or two, but maybe the next month or two, there can be, we can put this kind of storm behind us. So, as far as mortgage rates, fixed rates go, the fixed rates are being held higher. And the main reason I mentioned that, but before COVID, fixed rates were in the low 3% range. One of the main reasons they're staying higher now is because of deficit spending, government spending that's out of control for the most part, way over budget, and it's in Canada, but especially in the U.S. And in the U.S. to an extent where they actually are experiencing a resurgence of inflation. If you look at some of their key inflation measures, it is coming back, and this has the Federal Reserve and the states concerned that if they continue to reduce rates, this could push inflation even higher. And so they're keeping an eye. Trump's saying, well, you must lower rates, even though inflation looks like it might be coming back. I mean, so there's that whole debacle there. But really, um, at the end of the day, the U.S. bond yields are saying, yeah, it's coming back. Inflation's coming back here, and so U.S. bond yields are they're approximately 1% or even higher than the equivalent Canada bond yield. If you look at the 5-year bond yield in the States, they call it the Treasury yield. It's the bond yield in Canada. It's pretty much the same thing. Um, theirs is actually higher. And so if you could invest in Canada or the States, if you're an international investor and you're buying bonds and you see Canada paying 1% lower than the US bond yield, where you're going to say, well, you know, I need to see a little bit more from Canada before I put my billions of dollars into Canadian bonds. So that's kind of one idea how it works. It's not that simple. It's more dynamic, of course, but there is inflation, more inflation in the States. You have to buy those bonds in US dollars, which could get eaten away by inflation. But nevertheless, there comes a point where the US bonds are high enough that Canada's bonds have to pony up, pay a little bit more to that investor. And so you see upward pressure on these bond yields. And this, of course, affects fixed mortgage rates, not the variable rates, which are directly affected by the Central Bank of Canada, but the fixed rates are very much affected by bond yields, which are very much affected by the U.S. and their inflationary environment. So we'll touch more on this and how this works over the coming weeks. But overall, I mean, it's a bit of a shit show out there. It's a bit of a storm. I do think, and this is based on what we've seen in the past, based on what is almost impossible that can happen. This will resolve. We kind of all know this in the back of our heads. The financial markets, they know this. They might, have a spike or two here and there, but as of right now, the financial markets are keeping their cool. I think so should we. A lot of noise out there, but again, even with another scare or two, I remain cautiously optimistic. There will be solutions, and that, over time, the economy will continue to just chug along, grow long term, and we'll all be more than okay. Thank you so much for watching. Appreciate your time, and look forward to the next one. Thank you.